And this is Mr. Greg Dickerson. How you doing, sir?
Doing great, Michael. Good to see you.
Nice to see you as well. So something you have championed, brought to the channel probably 3, 4, 5 months ago was this notion of great deleveraging. I want to kind of break that down and ask you specific stuff about what is going on in our economy right now, what is going on in the Fed, and talk about the future a little bit. You ready?
I'm ready. Let's do it.
Awesome. So what do you think is if we talk about inflation, right? If inflation is the topic, right? It's the middle of January. Do you think the Fed is clearly behind the curve as we sit today?
Yeah, they're way in over their heads. They were ignoring it and denying it for way too long. They've lost credibility from a policy standpoint, meaning the rest of the world has no faith that the Fed can make the right decisions to fight inflation, which is now a global thing. This is really Fed policy in the United States is affecting markets and economies around the world. So they've lost credibility around the world that they understand and have a grip on what's going on. What the rest of the world knows that the Fed has not acknowledged yet is, they said we're going to raise rates 4 times next year. We're going to, lighten up on the balance sheet, and we're going to, stop the asset purchase and liquidity flow. And what the rest of the world knows, and what most people know, is it's too late. Unless they act drastically up front, inflation is so out of control now, and it's going to continue to get worse. There's some transitory components, but at the end of the day, it's bad. It's, we're double digits, probably close to 20% real inflation.
Yeah.
What they're measuring, they know doesn't accurately account for what we're really experiencing. And everybody watching this knows. And what's happening is you're getting to the point with inflation where you're going to have civil unrest. That's when you have a serious problem from a political standpoint. When you have people marching in the streets and showing up in Washington because they can't afford food, they can't afford shelter, and they can't afford clothing, the Fed's got to move, and they got to move fast. So what does that mean? Paul Volcker, Alan Greenspan. So the only way to stop inflation at this point, where we're at now, and everybody knows it, is you got to put the U.S. economy into recession. That's the only way to stop it.
Oh, you're reading my notes. So the next question, we're still going to walk through this so we can get to I think we're in the same place. Absolutely. So again, I agree with everything you've just said. So the next question I have is, can the Fed catch up?
Well, yeah, they can, but will they? That's the question.
That's the next question. But can they?
But yeah, they can. So if the Fed came out and just right off the bat stopped all asset purchases and raised rates at least 0.5 point, if not 3/4, and that's what they have to do, not this 25% or
exactly.
You got to come out and you got to swing a sledgehammer, and you got to raise rates, 500 basis points, to 750 basis points, which is 0.5% to 0.75%. Sounds like a lot.
Yeah.
And cut everything else out at the same time, and then let the chips fall where they fall, and let the markets deleverage, let everything come back to home base. And then you can, let things kind of stave off from there. But I don't think they have, I just don't think they have the backbone or the stomach.
Yeah, no, so far we are in painful agreement. Can they? Absolutely. And I've actually said it for months now on my channel that the first move has to be 0.5 point. If the first,
the other caveat is, as you've seen, I've sent you a couple articles, the politicians have exited their positions.
Yes.
And so have their, institutional investor buddies. So yeah, they can now. Now they can do it. They couldn't before because they had to get everybody out of the market first. And, and I'm not kidding. If you look at the stories out there every day, there's a new story coming out about one of the politicians in Washington, Congress, Senate, in DC, that have been taking advantage of Fed policy and insider information to really do well in the stock market. That's the other thing that's causing a lot of civil unrest right now. The more of these stories that come out, the more people are getting ticked off. So they have to do something now at this point.
Yeah, I totally agree with you. The only way this gets better, again, can they, is Jerome Powell has to be a mini Paul Volcker. He can't be Greenspan, can't be Bernanke, can't be Yellen, can't be the one that, hey, the market throws a fit and then you stop, or heaven forsake, reverse. You've got to be able to suffer pain, and you've got to probably kick this thing into a recession. So can they catch up? Yes. Can they build confidence? Yes. So the next question is, will they? What do you think?
At this point, it's a political issue. And,
Mm.
you have midterm elections and you have the presidency coming up. So unless they do something drastically that they can, so the only thing they can do is put the country in recession, create a serious economic situation to get inflation under control, which is going to hurt, people in another way, because you're going to see real estate values, stock
Stock
values,
market. Yeah.
all of that's going to unwind. So that's going to hurt the wealth of people, which hurts spending. But if you leave inflation where it's at, that's even worse. So it's a no-win situation unless you let it get really bad, and then right before the election, you jump back in and save everything, and
Yeah.
all the markets and everything is back off to the races, and the current administration looks really good because, hey, we were headed into economic Armageddon and we just saved the world. So they're having these conversations behind the scene. Let's nuke it now so we can revive it later. They have to do something. They can't just ignore it, because again, you will have people marching in the streets if this goes on much longer.
Yeah, this is 2022 is going to be a very interesting year. And I think back to kind of the earlier conversations, one you mentioned in the Grant video, it could get to a point where high-end real estate doesn't sell. I mean, they become the notion of a white elephant. Remember that? The whole white elephant, nobody can sell these arbitrage, beachfront homes, because they're just not trading, because nobody wants them. So, I mean,
and there's a certain level of ultra luxury real estate where, people just don't care. They pay what they pay. But when the economy's bad and when it's risk off, again, don't fight the Fed works both ways. It works going up, it works coming down. So when the Fed is coming out with guns blazing, you can't fight the Fed. What does that mean? You take on risk assets, because they're the 800-pound gorilla buying bonds and all that. Well, when it goes the other way and the Fed's unloading and they're not pumping liquidity in the market, then you can't fight the Fed that way either. Yeah. So what happens is, and we saw it in 2008 and 9, the first segment of the market that took a hit back then was all the luxury stuff, all the high-end restaurants, all the high-end hotels, all the high-end vacation spots, all the high-end houses. They all came back. It was a long time before the luxury real estate market did well. The last couple of years, it's done exceptionally well because interest rates are really low. And at a certain level, you have people that are paying cash, they don't care. But still, the luxury real estate market was suffering for a long time, and it really came back, and backed up quite a bit over the last number of years. And in the last 2 years, it's kind of picked up a little bit, but that'll be the first sign. We talked about it before. You'll see it in second home markets and you'll see it in luxury real estate. That's your first sign that the real estate market's turning.
Yeah, I agree. So when you think about where we're at, what do you think will be a bigger policy mistake? Because clearly we both agree they're late. They let this thing go too on. Transitory was perhaps the worst call ever. Or will there, I do think he's going to come out hard. I'm still calling a half a point hike, because this 25 basis points is going to be nothing. Do you think he's going to be able to hold on, or do you think he's going to relent? I guess, as you're saying, right, come October, they're going to come back and say, oh, it's all good, blah, blah, blah. In their cut rates?
Yeah, I don't know. And a lot of it's going to depend on, all of the, CPI reads and employment and all that. I mean, so far he still has been pretty soft, even with him coming out saying we're going to reduce the balance sheet, we're going to stop, the taper, we're going to unwind that. And we're going to start tapering the asset purchase and we're going to raise rates. It's still mild. Yeah. Hey, you know what I mean? They're still buying how many hundreds of billions a month, and he's only
they haven't even stopped. Yeah, they got a $9 trillion balance sheet and they're still buying for a couple more months. It's crazy.
Yeah, and we're going to raise it 25 basis points. I mean, it's still weak. It's still very weak. And again, that's why they've lost credibility, because people are going, you still don't get it.
Yeah.
So they have to come out very strong with guns blazing, or they're going to go down as the worst Federal Reserve Board of all time.
I agree.
And, worse than anybody in the history of the United States, and the damage that they're doing now and the damage that's going to be done to unwind it.
Yeah. The damage to unwind it is going, I think I read a quote or heard it. I don't know if I read it or heard it. Basically, if we keep kicking the can down the road, the pain that we're going to feel now will be paid with interest, which is a scary thought. The biggest thing for me that I think is going to be that is not being appreciated is not the stopping of the taper or the getting done. It's not even raising rates. To me, the big thing, Greg, is they're going to become the biggest seller of treasuries, not the biggest buyer. I don't think people have appreciated, because again, bonds are inversely correlated. The Fed doesn't have to make money. So if the Fed sells a bond and they're unloading 100 billion, no, there's no buyers. What do? Well, you raise the rate. Are there any buyers? Nope, raise the rate. Eventually, and well, we could see some really fast movement in rates, I fear. What do you think?
Again, that's what I mean. Don't fight the Fed. So what happens is that they start selling, they start, unwinding the balance sheet, rates go up. That's where that's where your money goes to now. And where would the money have otherwise gone? Into risk assets.
Yeah.
Now they're going into treasuries, and we're already seeing it. The 10 years, almost at 2%.
Yeah, I think it was 1.8 or 1.79.
Yeah, as soon as you cross 2% again, then eyebrows start to get raised and things like that. But I mean, it's over my head in terms of what if they don't do anything? How far can it go, and how bad can it get? And some of the inflation is pandemic, related in terms of supply chain, things like that. And we were doing fine until the pandemic, and we experienced that little disruption. But assets were a different story. So the question is, how far and how long could you keep pushing, inflation in assets without real inflation in the consumer, index, which you and I talked about for a long time. We saw hyperinflation at the asset level, and hyperinflation is a big term, but when you look at markets, man, it's parabolic over the last year. From when the Fed threw that $1 trillion at it. Real estate, not quite as much as the markets, but it has a big up curve, with 30-40% over the last couple of years. But we still weren't seeing real inflation at the consumer level that was impactful until the pandemic. So some of that's going to be transitory. So, if it starts to come back into check once, we get through this and get all the, supply chain issues resolved and, kind of ease the demand a little bit, it'll just be interesting. I just don't know how far you can go if you don't have real consumer inflation, but you keep pumping up the assets. I don't know how far that can go.
No, it's time to pay up. I really do think that. And again, the Fed has a meeting, I think the 27th, 26th, 27th. So first meeting of the year.
Now, this isn't, doom and gloom. This isn't
not at all.
And this and that and the other. It's just deleveraging. So, you have to deleverage every so often in markets, they pull back and they go up and they pull back. And, we just went too far too fast. And now we have to unwind that a little bit. There's only two ways to do it. Number one, from an economic standpoint, you tax, liquidity out of the market.
Correct.
That's one way. The other way is, you start selling off, stuff, and you raise interest rates and things like that, and you cause a recession. So, that reduces demand, right? What is a recession? So that's, drop in growth. You reduce consumer demand. So prices, should come down. The less demand for something, the better the prices are going to be. So that's their real issue, is that there's still too much demand, not enough supply. So that's the issue there that could unwind potentially, with Powell, as interesting as his thought process has been, you just don't know what he's going to do.
It's going to be interesting. So again, folks, we've been talking about the great deleveraging. Give full credit to Mr. Greg Dickerson for calling that. He has his own playlist on this channel with 100 hours of material. Go check it out. But if you want to find him, how would you like to do that, Greg?
Yeah, gregdickerson.com. That's where all my YouTube channel podcast info lives. gregdickerson.com.
Thanks, buddy.